Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. All of us have read about or at least heard of Silicon Valley Bank, based in California, US. It collapsed a couple of weekends ago. This was followed by the collapse of another bank, Signature Bank. Then a third one, First Republic Bank, almost went down, but thanks to infusion of funds from large financial institutions nudged by US authorities, it steadied itself somewhat. Where did all these troubles begin? And how did the US government react to all of this? All of this actually throws up a debate. Is it all right to use taxpayer funds to save depositors in banks? Let's take a look. What led to the collapse of SVB? Often there is no one single reason that gives rise to such a large financial event, but we'll look at what is the most obvious. But before that, a little bit of history. When the pandemic hit us, several central banks, especially in the Western world, started infusing easy liquidity into their financial systems. The US Federal Reserve infused about $4.8 trillion into their financial system between February 2020 and April 2022. There were no avenues for investment at that time. Remember, during the pandemic, the world almost came to a standstill. So companies weren't moving goods, they weren't making immense profits. So economic growth was actually slowing down. So when there was easy money available at almost zero interest rate, entities such as Silicon Valley Bank did not have too many avenues for investment. So what did? They put a bulk of these in government securities or bonds. When inflation began rearing its head in early 2022, like all of the Western central banks, the Federal Reserve too began raising its rates. And it has been at it relentlessly. Between March 2022 and February 2023, the benchmark interest target range has gone up by about 4 percentage points. The Fed's actions actually helped spur bond rates up, or bond yields. When this happens, the price of bonds actually come down. As this kept happening, the value of holdings by entities such as Silicon Valley Bank started going down. So as early as the September 2022 quarter, the value of its unrealized losses stood at $16 billion, compared with its equity base of $11 billion. And I say unrealized losses because if you hold a particular item, a share or a bond, and you see notional loss because its value has gone down after you buy it, unless you sell it, it's not realized loss, it's unrealized loss. And when the bank finally on March 12th this year said that it needed to raise further funds, depositors became wary and started withdrawing their funds. They withdrew $42 billion from the bank in a single day. In tandem, Moody's cut the bank's rating because of the decline in the bond portfolio, and the stock tanked 60%, sending ripples into the financial system. Specific to the case of Silicon Valley Bank is the fact that a good chunk of its depositor clientele came from the startup sector. You may recall from an earlier episode of Business Matters that the startup sector entered its winter of funding or lack of further venture capital funding a few months ago. So when there was no more fresh money coming in from venture capitalists, startups tend to lean back on the bank deposits to run their operations and pay salaries. So that was an added headache for SVB. You may have noticed that historically, governments across the world seldom let large banks or banks of any significance fail. Why is that? Because there's always a contagion effect. Banks are interconnected in the financial system. There is also a problem of perception among depositors. Even if a bank is technically sound, a mere unverified rumor can cause panic among depositors. And no bank in the world can give back all the deposits to its depositors at once, because bank makes money by lending out those funds to borrowers. And it's impossible for any bank to call all those loans back just in order to be able to pay back depositors. So in the case of SVB and Signature Bank, the US government intervened and shut down those banks, but assured depositors that their funds are safe and that they can withdraw all of these at any time. As an aside, in India, you may know that the government has marked 3 banks as systemically important or too big to fail: State Bank of India, ICICI Bank, and HDFC Bank. Then came bad news from this large European financial institution, Credit Suisse. So did the contagion effect actually travel all across the Atlantic into Europe? Not really. Credit Suisse has been in some trouble for a couple of years now. It had reported losses for 2 consecutive years, 2021 and 2022. It had promised in October 2022 to restructure its business, promising to focus more on the wealth management business rather than on investment banking. It had also been penalized following the loan scandal in Mozambique. But have depositors continued to withdraw funds from Credit Suisse? They sure did, considering all the trouble it's been through. In all of 2022, depositors withdrew $133 billion. Actually, all the panic regarding Credit Suisse came out in the public domain after major shareholder Saudi National Bank refused to infuse further funds. Fortunately, Credit Suisse got a lifeline with about $54 billion of a loan from Swiss National Bank. It seems to have steadied its ship temporarily. Even as we record this for you, the board of Credit Suisse is considering a proposal to merge the institution with another Swiss bank, which is UBS. That brings us to the key question which has thrown up such a hot debate. The US government stepped in to protect depositors of SVB and Signature Bank. But is this a bailout? If so, is it being done with the use of taxpayer money? Is it the right thing to do? The US regulatory authorities are at pains to explain that all they did was to protect depositors, not investors, not the officials of the banks. The banks would cease to exit, the officials won't hold their positions anymore. The investors anyway trade in stocks knowing that there is always a certain amount of risk. But the deposits would be protected, even the uninsured ones. How did the US authorities achieve this? They did this using a fund that was paid into by US banks. Balances in this fund would be used to allow depositors to claim whatever was due to them. But as Washington Post recently cited economists as saying in an article, that the fund itself was backed by the Treasury. So if the fund ran out of money, the Treasury would step in to save depositors. And whose money did the Treasury hold? Taxpayers. Think of a loan that a friend takes out from a bank where you are the guarantor. You don't have to pay anything till the friend keeps servicing the loan. But once the friend defaults, the bank won't go after your fund. It will come after you. You're the guarantor. And in the above example, the Treasury is the guarantor. The role of global rating agencies has again come into question, reminiscent of the 2008 financial crisis. Back then and now, there were no early warning signals that came out from these agencies that typically consistently monitor the health of such financial institutions. Though rating actions had raised awareness just before the apocalypse, it was likely a case of too little too late. As we saw earlier in this conversation, the Federal Reserve had raised interest rates, and in tandem, the Indian regulator, Reserve Bank of India, has also raised its benchmark interest rates. The repo rate went up from 4% in April 2022 to 6.5% in February 2023, an increase of 250 basis points. So we come to the next logical question. If the Fed raising interest rates has affected some corners of its financial system, won't RBI raising rates affect some of our institutions likewise? There is no yes or no direct answer. The responses lie in the realm of probability. But analysts have been saying over the past few days that the local currency liquidity is robust because of the basic funding structure of Indian banks. 63% of all deposits in Indian banks come from households. On the assets side, the Indian banks' loans as a proportion of assets was at about 57% in March 2022. This is much higher than, for example, Siliconvalleybank's 35%, thus making Indian banks less exposed to the risk of plummeting bond values. Further, government securities formed only 18 to 22% of bank assets in India, according to brokerage Jefferies. So Indian banks may not be at such a great risk for now. An analysis by sister publication Business Line shows that Indian banks have added rupees 15.9 lakh crore of government securities since FY21, and the approximate loss on these assets could be around rupees 97,000 crore. But with most of these securities being held in the held to maturity or HTM category, there is no immediate risk from these assets. That is, the change in valuation of bonds held in the HTM category does not have to be recognized periodically. As an aside, you may know that banks categorize the bonds that they hold in three categories. First is the held to maturity, the other is the held for trading, and the third is available for sale. Except for the first, the other two have to be marked to market, which means whatever changes in the value of those bonds have to reflect in the books of these banks. The other thing to note, and a point that is in favor of Indian banking, is that in the Indian system, there is a clear demarcation between core banking services and other services such as investment banking or wealth management. So if at all there is an issue with other accessorial services, the core balance sheet is still protected and there is no spillover of these problems, and subsequently the depositor interest is also protected. As Bank of Baroda Chief Economist Madan Sabnawis told Business Line, Credit Suisse is not a pure commercial bank. It is an investment bank and also deals with wealth management. And that's where the money has been evaporating and the investment bank has been making losses. That is where investors were apprehensive to lend more and liquidity issues came in. That's all we have for now. Watch the space for more because the story is not obviously over yet. Till we meet again, have a lovely week ahead.